I really want to start with talking about being prepared for an event that, Corona presented itself. So, I can give a little background with, Typhon that, our ideas around this really started, before the Christmas holidays, where we started to have, single manager discussions and, smaller group discussions about, what could possibly happen. So, Vasant, can we just start with something, really easy, a nice little softball question about, these events are rare. They're not common. They're global in scope. So, where does the discussion start on a day-to-day business viewpoint or a trading viewpoint of where, hey, this is something that we should have some sort of tool belt for, and how do we go about doing it?
Well, it's a great question, and it's actually not such a lowball question. It's actually one of those really vexing questions for a systematic manager such as ourselves, who normally run on autopilot. And so someone in the previous panel, I don't know if it was Mike or someone else, said March was a difficult, interesting period for anyone on autopilot. And that's absolutely correct. I mean, if you think of the way systematic strategies are constructed, they're either structurally engineered for a certain outcome. And so if you were long vol, great. If you were short-term momentum oriented, great. You're sort of structurally set up for doing well in that kind of strategy, although most other times you'd probably bleed money. So the question you always ask yourself as a systematic machine learning manager is, has this occurred in the training set, right? Have you encountered this type of a crisis in the training set in the past? And the answer is that it's not knowable, right? You may have, because clearly the training set includes stressful periods, it includes sell-off, it includes certain kinds of crises. And so the question that you always ask yourself as a systematic manager is this a new unknown where there's a decent chance that the system has not been trained on this kind of data? And the tools you really have are, you have to ask yourself whether you're functioning at the right level of risk, because the direction is a complete crapshoot at times like this, right? So the question really boils down to, are you taking the right level of risk? And I maintained a really detailed diary during COVID because it's easy to forget what it feels like in the middle of a crisis, right? It's easy to sort of retrospectively rationalize what really happened. And I wanted to avoid that. So I kept a diary beginning on Feb 21st, which was Friday, I think. And looking at the VIX on Monday, the 24th, after that big, 3.5% sell-off. I mean, the VIX didn't, skyrocket. I mean, it was like 23, 24. The markets continued to gyrate on Tuesday, Wednesday, massive moves. And the VIX barely edged up, it barely edged up to like 25 at the end of Wednesday. And, I was really scratching my head as a systematic manager. I also teach a class on systematic investing at the Stern School of Business at NYU. And we've been discussing this thing since the end of January. I've got lots of Chinese students, and they were expressing all kinds of opinions about how this would lead to, global stress and a massive sell-off. But it didn't happen. I mean, the market made an all-time high on Feb 19th, right? So the question really on the 24th was like, what's new? Like, we've known about this for a while. And I looked at the news and there wasn't anything significant. There were like, there was a story out of Italy, there was a story out of South Korea, but, nothing to suggest that, this is a crisis, right? I mean, and that's the thing about a crisis. You don't know you're in it until you're really in it. And so the early stages of the crisis are the most challenging. And one of the things that we do at SCT is, we tell investors we are 100% systematic, but we do reserve the right in very unusual situations to cut risk. and that's the only action we'll take. And that's essentially what we did. By the time early March rolled around, we just said, I think that the machine and the market is underestimating the risk. That is, the risk to the downside is much higher than the other way around. And so this is one of those situations where I say that human vigilance, pays off. And this is one of those times, one of those very unusual times where, there's a role for human, because you can actually reason about this and say, am I taking the right level of risk? And to us, that was the critical question. And the takeaway was that the market was underestimating risk, and it was dangerous to do so. So not a lowball question, unfortunately. It's a really, meaty question.
Mike, I want to talk a little bit about the reduction of risk. So, and Vasan, we'll get back to you with this too. So when you're looking at this, and we kind of had a dry run with the livestock market, with the Asian swine flu coming through, and how that was going to affect prices, and it didn't have the impact we had already anticipated. But when you're looking at a reduction of risk, is it just clip size? Is it the money you put to work? Is it a margin reduction? Do you widen your parameters to trade, your trading signals? What tools are there that you tend to lean on? And then Vasant, we'll come back to you and ask the same question. But Mike, why don't you take it first?
Yeah, I think it's some of all of those. Specifically in the VIX futures market, those are larger contracts, 1,000 multiplier. So when the VIX is elevated and your one lot is all of a sudden 50,000 exposure per one contract, when the front month's trading at 50 versus trading at 25 back in February, there's room to cut just unit sizes down. There's room to use calendar spreads to reduce margin, reduce your net exposure, that kind of thing. So it's pieces of all of those processes that you mentioned for sure.
Vasant, what tools are you looking for when you start to cut risk? Is it just the size position? Is it just your clip size? Or are you looking at something else? I mean, obviously an increase in margin can really just do, when the exchange does it, can just do it all by itself, right? Like if you put an X amount of dollars to work, you're not going to be able to put as much to work with the margin being higher.
Well, the two things that we did. One is just estimate, come up with an estimate of like how much a system is likely to be underestimating risk, right? And there's no formula for that. There just isn't, right? And you have to estimate that. And in our estimation, we arrived at, the possibility that, the VIX could go up to 60, 70, right? I mean, if this continued for a few days, 3% moves, 4% moves, which in fact did continue, and the VIX went up to the 80s, we figured that, we could be underestimating risk by as much as, half, right? Or double, depending how you want to look at it. And so that's a heuristic that we used to cut position sizes, similar to what Mike's talking about. But the other thing we actually did was to also be cognizant of whether the trade we were initiating was risk increasing or risk reducing. And we just tried to keep a lid on risk increasing trades. And quite frankly, it was quite terrifying when your system's telling you to buy equities, during March, even though it turned out to be right during the latter part of March, right? It's as a human, it's just terrifying when you sort of reason about what's going on, and so you really can't get into the position of second guessing direction of these systems, right? Because as Keynes said, markets can remain irrational longer than you can remain solvent. And we've seen situations where terrible news comes out and the market rockets. Of course it would, right? It's just going to be, that's exactly what the market does. So you can't be second guessing direction, but in terms of risk, that's where you have to be really careful in terms of knowing that if your system is underestimating risk, cutting sizes, and being really careful about putting on risk increasing trades.